Welcome to All Things Moore County, Moore County's weekly radio show highlighting the many facets of the Sandhills. That includes real estate, lifestyle, community and neighborhoods. And now from Fore Properties, here's your host, Bill Sahadi.
Good morning. Welcome to All Things Moore County. I feel like I'm at a concert. Dorothy?
Yes.
Nice beat.
Good. I'm glad you like it.
I do. Well, we're going to keep it.
Okay,
for a while.
Okay. I'm good with that.
We're entering, school is ending very shortly.
Yep.
Believe it or not, we're coming upon the halfway mark of the year, and it's been a roller coaster in our real estate business. And when we talk about our real estate business, there are many different facets to it. We're going to be focusing today on the lending aspect of the business and what has changed and what people should know, because buyers are being challenged like never before. In 22 years, I've never seen a market like this with low inventory. Interest rates have finally started going up, and yet the demand has not ceased. We're going to be speaking with past guest Laura Kurtz. She's the Chief Production Officer. She is the person at Home Factor Financial who is in charge of training all the loan officers under her. She brings a ton of years of experience to the lending process. She's seen it all. When you talk about a perspective and a vision where someone can see the whole playing field, that's Laura Kurtz. And there's a reason why she comes on the show periodically, because we trust her. And we're going to talk in depth with her about the rules of engagement and what has changed. And we're also being joined by Fore Properties real estate broker Stephanie Lemke, who is, for my money, one of the most resilient, heartfelt brokers in Moore County, who has weathered a ton of storms this year, and she does it with a steely-eyed resolve. And it just so happens she happens to be a great lady on top of that. Stephanie, you've been in the business now 5, 6 years?
About that, yes.
Okay. You're like a cat. You have 9 lives. You always come back. You keep marching forward. I have a lot of respect for the way you handle your business and your clients. At the end of 2021 and into 2022, the rules of engagement for our business have changed dramatically. What do you see? How do you handle the changes, and what do you see as the changes?
There have been quite a few changes.
Yep.
People have been getting used to that super low interest rate. You know, we were seeing 2.25 as the lowest a year ago.
Right.
2.5, 2.75, a bunch of under 3% interest rates. And that meant they could afford much more of a house than they used to be able to. And now, with interest rates going back up, it's circling back around. You know, somebody who got pre-qualified 5 or 6 months ago is going to be surprised if they haven't been watching the numbers when they go for their approval.
That's where the rules of engagement on the lending have changed as well, which we want to talk about. But what about the way you have had to manage your clients' expectations in this crazy market?
Most offers that we're putting in are a multiple offer situation.
Right.
So they're not negotiating back and forth with the seller. They're competing for that one house against, 6, 7, 8 other people, especially in the low 300s and 400 range. The inventory is just too low right now.
It's not an uncomfortable situation for you to have to coach your buyers, especially, to be more assertive, to be more aggressive, and to make sure that they have a punch list of items that they have clocked before they submit an offer?
We're submitting offers full and complete. There's no informal offers being put forward. When they put an offer forward, I'm encouraging a very strong due diligence payment. And if they're not comfortable with that, sometimes we'll still work on some earnest money as well. But if they're not strong up front with their offer price and their due diligence, a very simple, clean offer, chances are they'll be outbid. If they're coming in with a big bank loan from some
We get
bank that just looks at
we break
them
out
as
in
a number.
hives when we hear big bank. We get allergies.
Yeah, and I don't want to put any names to the big nationwide banks that they're not people oriented. You are a number in a queue,
Yeah.
and it negatively affects them if they're competing with an offer that has a local lender.
Yeah. Laura, good morning, by the
Good
way.
morning.
The rules of engagement for you have also changed, haven't they?
Oh, yes, certainly.
Yeah. What's the biggest difference between the last 6 months of 2021 into 2022 and prior to that in your position?
The most obvious answer to that is the interest rates have doubled.
Right.
And that has impacted the borrowing power of each borrower. And it's also coupled with the short inventory that has just come into full circle. Excuse me.
Yeah.
And having those competing offers and buyers under so much pressure and their real estate agents under so much pressure to represent them properly. I
Right.
think that's the biggest.
Hey, Steph, if I had $1 for every pre-qual letter that Laura has written for so many of the buyers, the brokers that she works with, how many of them do you think come back where they say, oh, we didn't get the house? I mean, $1 for every letter she's written that didn't go to fruition. We wouldn't even have to be here.
We'd be sipping margaritas on the beach.
Yeah, we'd be on the islands.
It's heartbreaking. In a way,
It's hard.
it's heartbreaking. Has your coaching of your clients, once we pass a client on to you, has your coaching with them changed?
Very much so.
How so?
On the upfront, I have to explain to them
Yep.
repeatedly that the expectation is that they will likely pay full price, if not significantly higher,
Right.
for the house, and that is normal. Because I know that the real estate agents are out there explaining that to them, and they really need to hear it from multiple angles. And we see the appraisals, we see the offers, we have firsthand knowledge of that. And just preparing them for those multiple offer situations, letting them know the value that we provide by having that trust in the marketplace, being a local lender, doing what we say we're going to do. All those things really do make a difference in just the offer stage alone, not just for them throughout the process. And it hasn't changed the amount of time we spend with the client up front explaining things. It's just how we deliver the information to them.
Yeah. The some of the coaching, we have always done has always been to try to speak directly to our buyer client about the value of a local lender. Never more important than in 2022. People who get involved in multiple offers, when we present offers, we have a grid of things that are most important, especially if you're representing a seller. What is most important to the seller? Well, a local lender, you've got your purchase price, you've got your due diligence money. Where is the financing being done? Is it being done, in an online finance vendor? Is it being done by, as Stephanie said, a big bank, or is it being done by a respected local lender whose reputation resonates in the local broker community? As a listing agent, and Steph is a listing agent.
Yes.
Isn't it good for you to tell your seller, I know Laura, I've worked with her. When she says something's going to get done, it's going to get done. And that is in their best interest. It's not just rate. It's not, but that's another conversation we want to have.
And she knows how the local culture works when it comes to the closing attorneys, too.
Right.
When you get an online lender,
Right.
they're asking for things way up front, 30, 45 minutes or 30, 45 days early that our attorneys don't have until the last 2 weeks.
Yeah.
Laura knows that. She knows Cammie at Thigpen and Jenkins. She knows a lot of the paralegals and can work with the local attorneys in the way that makes sense.
The buying public, the buyers don't understand the relationship between the lender and the attorney. You've been on both sides of that fence in the past. Can you explain why that relationship is so important towards the seamless nature of a transaction?
Yes, I spent 13 years as a North Carolina paralegal.
Right.
And saw what happens at a closing and sat in the seat of those people. It is the most unappreciated, thankless job in our industry. And they make every bit of difference at closing. They're the ones who are the last people to speak with us, the last people to speak with the closing customers, the sellers, the buyers, the agent, and to understand what they need when they have to bring all the documents together, all the information together, then deliver it to all these parties and have it be communicated properly and accurately. That's a very difficult job, and it's up to all of us to give them what they need ahead of time so they can properly take care of that. And if they're not appreciated and they're not respected, it makes it very difficult for them to get that job done.
Stephanie mentioned Cammie David at Thigpen and Jenkins. So each year at Christmas, I'm always, Cammie loves to go out and to a good restaurant from here and there. So I'm always getting her gift certificates. I probably should just buy her the restaurant because honestly, what Laura just said, the amount of work that they do behind the scenes, under the radar, and their backup is they can't even look at, a lot of clients don't understand why the attorney hasn't looked at their papers 3 weeks prior to the closing. They're so backed up. You have to take a number and get in line. It's crazy. I know when Cammie knows Laura, you're on the other end of it. It kind of makes her day. And when she doesn't know who the lender is, she will figuratively roll her eyes like, oh God, this is going to be so much more difficult. But that you respect that relationship, and I think she respects it on your end, and as does Frank Thigpen. He speaks about you all the time. So your job is not easier in this environment, and yet people will say it still beats renting.
Yes.
And people sometimes have to look at the big picture that way. Yes, they're paying more for a property. Yes, their interest rate is higher. But at the end of the day, why not, instead of talking about that, why not talk about the monthly payment? What is it going to cost you a month to live and occupy that home and control it as an asset? And so what if it's 5 whatever percent? If it's still less than leasing, aren't you still better off?
Yes, and that's not being talked about much right now. I speak about that with my clients and people that are referred to me. You're going to pay what the market value is for that house unless you already owned it or already occupied it as a tenant. So if you're entering into the housing market now, you have to look and see what the market rent is versus the market mortgage interest rate and subsequent payment. And that will absolutely make the decision that you will want to buy a house.
Yeah.
So the expert on rental property is having to sit right next to you. Stephanie, you own a couple of rental homes. What have you seen happen with your the prices on your leases as you've gone from one tenant to another?
The tenants the homes that we turned over during COVID and after COVID, well, not after.
Right.
We were able to increase the rent quite a bit. With the asking rent, and the people who are already there, we're not great at raising the rent very much. So we're definitely getting below market rent on most of our properties.
Yeah.
And we're okay with that. But when I look around at somebody's like, I just want to rent, and I'll pull some things off the MLS for them. They're paying $2,000 a month for a 3-bedroom, 2-bath townhome or small home, it's not cheap to rent around here.
Are most of your tenants,
Not going anywhere.
well, are they signing a 1-year lease? Are they signing a long-term lease?
We mostly do 1-year leases.
Yeah, because, I mean, you may be able to make an argument that somebody who knows they're only going to be here for 12 months, yeah, maybe they should overpay and rent for a year. And
Sure.
But if they're here for 3 or 4 years, the math, I don't think the math works, does it?
It does not.
Even at let's say 5.5%, it doesn't work. Yeah. One of the things that's gone away, Laura, has been the seller paid closing costs, right? All these buyers, and when I say all these buyers, I'm referring now to a lot of the military buyers who are doing VA loans.
Mm-hmm.
It was almost like a right or a privilege to ask to have the seller pay some of the closing costs on behalf of the buyer.
Mm-hmm.
That's gone.
That's gone.
I mean, have you done one loan this
No.
year? Not one.
Not one. Probably in 8 months in our market.
So that means the buyers who are applying for the loans obviously have the funds to do
Yes.
this themselves, and they're probably better qualified today to buy a home than they were 4 years ago,
Yes,
right?
that's true.
And
They
that's something.
have to come with money up front. There's no way you can get a contract on a property if you don't have
Right.
a little bit to put down at least.
And in a multiple offer situation where a seller has the choice of 4 or 5 offers, sometimes they tend to look at a cash offer as, the front runner. They'll look at a non-government loan, maybe a second place. But Laura, you've said to me that is not what they should be looking at.
Right.
If they're doing a government loan, why should the seller be assured that that's actually a good loan to have in this market?
Because they're easier to understand the qualifications, easier to get through underwriting, and more likely to know up front if there's a potential problem. And also appraisals on VA loans. VA demands appraisers have certain turn times. It's mandated when an appraiser signs up. Now, it doesn't mean they always follow it, but the majority of the time they do. On conventional appraisals, you can see those turn times anywhere from 2 weeks to sometimes 3, 4, 5 weeks because they're so backed up, and
Right.
there's nothing that can be done about that. Whereas VA will step in and encourage the appraiser to get it done faster.
So the timing becomes actually more fluid if you're doing a government loan. Because
Yes.
you're right, the appraisal backups are maddening.
Yes.
And you don't have any direct control over who you get the appraisal ordered, but you have no control over who goes in and does the work.
Correct. By
and-
law, that's a law.
Yeah.
You can't have that control.
And we know sometimes that when the appraisal has been picked up by someone, we know whether we're going to be on the express line or whether we need to, take 3 weeks off, chill, take some beta blockers, and just pray that it comes in.
Right, and the laws don't allow us to say, oh, we didn't want that appraiser, we need a different one. We don't get to do that like we did
Yeah,
prior to the crash.
yeah. Let's come back in the second set. Want to talk with you about scenarios because some buyers are smart where they'll come in and they'll say, not what am I approved for, but what is here's the monthly nut that I want to have, and how does that back into a loan amount? It's important. People have to be big picture, and one of the things that we like so much about you is you paint great big pictures, because if you start to micromanage this world, you are not going to be able to get up in the morning. Everything is big picture. Laura Kurtz is the Chief Production Officer of Home Factor Financial. She's our guest for the hour. We'll be right back. This is All Things Moore County. Welcome back to our second set of All Things Moore County. Our guest for the hour is Laura Kurtz. She's a Chief Production Officer of Home Factor Financial and one of the most respected local lenders in Moore County. But Laura, you serve lots of areas in North and South Carolina?
North Carolina, Yes, North Carolina, Virginia, and Florida, and almost Georgia.
What percentage of your business is or Moore County in particular?
Probably 80%.
That's okay.
Mm-hmm.
So
The majority.
Yeah, and you have a very loyal following of informed brokers who know that you're an integral piece of the puzzle if they want integrity throughout the whole transaction without surprises. But you also have some information you want to share with us about with the prices of homes these days. You've got a graph or so that will show how long it would take to recover a premium price home.
Yes, exactly. We actually built a tool. Our president and CEO, Tuck Reed, built a tool based on what the history has been on the expected appreciation of a home based on national averages. And we take the price of the home, the expected appraised value, and figure out the break-even point if the customer is overpaying for the property, so paying a premium for the property, and what the expected break-even point of that payment would be to when the house appreciates to match what they paid for it.
And what kind of a timeline does that usually suggest?
Usually about 3 or 4 years.
Okay. So most people who are buying homes, who are coming here, a lot of people are here for 3 or 4 years or maybe 5 years. And I always talk to my clients and I always tell them, yes, maybe you're paying more for a home than you would have wanted to, but you're still better off than renting. But what's your monthly payment? Are you meeting your goals? If the answer is yes, then I always say a noble goal in this market would be that at the end of the time you're here, 48 months or 60 months, you break even. Anything over and above that is gravy. That seems to resonate. I don't know if you have that same coaching opportunity with your clients, but people, the market's not going to appreciate 4% every year for the term of ownership, right?
That's correct. And Moore County, thankfully, over history, recent history, has appreciated better than the national average by far.
Crazy.
So these formulas are on a conservative approach, even though none of the expectations can be guaranteed. They are, it's an educated guess versus a shot in the dark and an unknown. And we have very strong appreciation rates here.
Yeah, we're not a type B market anymore. Like we were always a type B market. If the national market was up 6%, we would be up 2%. But if the national market was down 5%, we would be down 1%.
Right.
But today we're sort of picking up the pace a little bit.
And the supply and demand issue is a real supply and demand issue. So that speaks to the odds are in our favor of stronger appreciation, not less appreciation. We have a whole group of millennials coming to be first-time home buyers. Builders haven't been building enough homes for myriad reasons. And so now we have a true supply-demand issue. So those values are expected to stay strong and keep increasing. We do not expect this to behave as a bubble.
You do not.
We do not expect that.
We just finished a loan with the Stewarts. You just finished a loan with the Stewarts, and they're first-time buyers, and they made me remember when I bought my first property in Philadelphia, way back in the 1970s. My realtor was. She maybe was in the business 3 or 4 years. She was as honest as the day is long. She had a heart the size of, she was just a wonderful lady. And I completely bought into her honesty, her advocacy. Even though she didn't know everything, she went out and she found out for me exactly what I needed to know. And I told the Stewarts, as first-time buyers, I never forgot that interaction. And it set a tone for me for future transactions. Steph, I think you have that same effect today on a lot of your clients when they'll look back and they will always remember what that transaction with Stephanie Lemke was like. It's a privilege, right, to do what we do. Laura has the same opportunity. You love working with first-time buyers.
I do.
Why? For the reasons I just said?
For those reasons, yes. And they just need the help.
Yeah,
the most, and
counseling.
it's really rewarding to help them. through the process.
Yeah. That's what it leads me to a question we were talking at the break. We are always coaching buyers to use local lenders. Steph, always, right? And it's become part of and parcel of what you say.
Yes, I've had many clients start with, oh, I found this online bank. Oh, the bank that I keep my checking account with
Right. Right.
has this low interest rate. I'm going to go with them. And then as soon as we get going, things start happening. They're just a number. They don't get calls back on the weekend. They don't get calls back on, in the evening when my clients need to talk to them about something. And Laura, you've taken one of those clients recently from me and got them to the finish line. They closed with you just last week. You tell us, please, why Home Factor?
Oh gosh. Well, Home Factor exists for a few reasons. We actually created this company back just over a year ago. And the group of us, my president and CEO, Tuck Reed, and Hans Thurston, our CFO, and myself, and a group of others, decided to build something different. We know that we don't want to be salespeople. We want to be guidance. We want to be advisors. We want to help our people. We know if we do that, then all the economics follow through that. We don't need to worry about the economics if we're helping people properly and being ethical. And that's where we started. And trying to build a model after myself and my processors that you guys are used to. You notice that they're still here with me.
Same names.
We have the same people.
I checked the email. It's just a different at.
Exactly. And we trust them very much. They take very good care of us and our clients. But we also knew we could do that, give that best service that we can give, and offer the lowest rates in our model that we have now, and truly the lowest rates.
Can you talk about the model?
Yes.
How is that possible? How much of it do you want to get into?
Oh, we're very transparent. It's exciting.
Because buyers want to know, because they're interest rate driven, especially today.
A typical lender that you work with, whether it's a bank online or what's called a correspondent lender, they typically make about 300, 400 basis points per loan. So call that 3 or 4% of the loan amount.
Okay.
We, as brokers, our max comp is 300 basis points. So right there, there's a difference. Why does that work for us in our model? Well, because we don't have to carry the overhead for the scaled economies that the wholesalers do. The wholesalers have scaled economies. So they pay for the closers. They pay for a portion of processing. They do a portion of it. We do a portion of it. And closing, underwriting, all of that's handled by them. But we can control it because we're their customer. And without us bringing business into their doors, they don't operate. So then we can take what we're doing, we pay our people properly, make sure that they get their share. And all of this is disclosed on the closing disclosure, as Stephanie noticed the other day. That's what that is.
And Stephanie would notice that.
Yep. And
What's
so
that number right there?
Right. And so we can focus our energies and our economics on hiring Christy and Christy to run the show. And I don't have to manage them. They report to me, but I feel useless because they do all of their work. And I can focus on the client and my other salespeople on the client and advising them and helping them. But it's truly economics. And those smaller lenders and even the bigger lenders are having trouble keeping their margins strong. So they have to raise the rates, they have to add fees, and we don't have to do that because it's literally scaled economies.
So in a higher interest rate environment with what we're in right now, is the discrepancy even greater in your favor today than it would have been in a lower interest rate environment?
Yes.
You're supposed to say, Bill, that was a great question.
Yes, that's a great question. But yes. Yes.
So good, Bill.
The margins become even better in your favor.
Yes, and that's why our rates are lowest, and that's why we also don't charge any junk fees.
What's a junk fee?
Processing fee, underwriting fee, commitment fee, admin fee. It's usually anywhere between about $800 or $900 and $1,500 typically, in addition to possibly origination fees, which we don't charge either. The fee that we show on our closing disclosure, that broker fee, is something all lenders get paid, but brokers disclose it on the CD. That's the only difference. And ours is less, but because of the rules,
Yeah.
brokers have to disclose it.
One of the most common questions I get from a buyer before they have committed to a lender, I'll make a referral to Laura, and they'll say, "Oh, I already have an interest rate. I already have one at X percent." And I sit there and I go, "Really?" And buyers can't have an interest rate until they have a contract that gets locked in, right?
Mostly.
The misinformation is ridiculous. The hopes and promises of what people think they're going to get, because people will say, "Well, can your lender beat this rate?" Well, it's not even a conversation to have.
I got this card in the mail.
Yeah, it's true. And that's where we have to step in and sort of, be your advocate in a little bit of way and defend to get them to you, to give you the opportunity to have that conversation. Because when you speak, there's something very credible about the way you speak, how you present, where people realize, hey, there's nothing really, it's all black and white. Here it is. That's one of the advantages of working with you, even if you weren't a local lender, but you just happen to be, so that's great.
Thank you. I think transparency is really the most important thing. Customers need to understand what's happening.
Yeah. I want to talk in the third set with you about interest rate locks, because that has become a real issue. Can you imagine somebody who applied for a loan in January or February of this year, locked in their rate, and they haven't closed yet, and the rate expired? That's not good.
No.
Now, let's come back and talk about that. Laura Kurtz and Stephanie Lemke are my guests. This is All Things Moore County. We'll be right back. Welcome back to our final set of All Things Moore County. Home Factor Financial is a local lender. Laura Kurtz has been a trusted resource for me. And for many of our brokers over the years, and year in and year out, she continues to prove her worth in her communication skills, her level of accessibility, and she's the antithesis of 1-800 Loans Are For Us. They're based out of Missoula, Montana, and if you ever have a buyer come in, Steph, who says, "I've been to Montana and I have a lender," run, or pull out a red flag.
Try.
The language of our market has changed, as well as the dynamics of the market. And there are things we talk about today that we haven't spoken a lot about. Interest rate locks, delayed financing. I want to talk to you about appraisal fees this set, because they've become crazy, and the consumer is bearing the brunt of it. And then working backwards on what monthly payments would look like at 4.5%, 5% on a $2,200 payment. There are big picture ways today you have to communicate how we have to navigate in these elevated times and these interest rate increases. Where do you want to start?
Yeah, it definitely, it's important for us to paint the picture for our clients. They don't understand it.
Right.
I say we start with the payments.
Okay.
What does a payment buy?
What does a payment buy? And this is the conversation you have with your client?
Yes, more so than before. The question isn't how much house are you looking for, it's how much house are you looking for, and more importantly, what monthly payment are you expecting, so we can make sure you're in the right price range.
Do you appreciate knowing that before you start the process with the client?
I do, and I'm assuming that the agents do too, because if you show them a home that they thought 6 months ago they could afford, and now they either can't afford it or don't want to afford it, it changes the whole scope of presenting homes. Their expectations are skewed. They thought they could afford a nicer home than they might now be able to afford, and that can take the wind out of their sails in the purchase process.
You talk about payment estimates for a $350,000 VA loan, and you gave us 4.5%, and 5%. that talking point work?
Well, first of all, I did these numbers about 2 or 3 weeks ago.
Right.
Now we're looking at numbers in the 5%.
Right.
But the most important thing to notice here is there's roughly about call it a $20,000 difference between the interest rates of what a $2,200 a month payment would purchase. And when we speak about that $2,200 a month payment, we're talking about including taxes and insurance escrowed.
Right.
So that way we're talking about the real number that the client would be paying. So back just a month ago, a $2,200 payment would have bought a $373,000 home
Okay.
in our market using
Okay.
our tax estimates.
Okay.
Now that same 2,200 is buying more in the 336, maybe even down to 310, 315
Right.
range.
Right. So there's less value,
Yes.
right? There's less value.
Yes.
But the thing that's important about the doing the monthly payments at 4, 4.5, and 5 is the insignificant amount of monthly payment, how it affects
Right.
it. What do you have on the $350,000 VA loan, the difference between 4% and 5%?
4% on a $350,000 VA loan in our market here is
Yeah.
a payment of $2,072.
Uh-huh.
4.5% is $2,177,
Uh-huh.
and 5% $2,285.
Basically $100 difference per half point
Correct.
increase.
Correct.
That's a dinner a month for two.
That's right.
Unless you go to the restaurants I go to, and no, I'm kidding. Okay. So that's another way to look at the big picture too, is
Yes.
what are the differences? We have to get people focused on what's the most value for their buck, ownership versus rental, and if resaleability is their number one goal, which it should be, not appreciation, they have a chance to recapture a lot of the monies that they have spent on their living expenses in that 3 or 4 or 5 year period. And that's financially, fiscally conservative as opposed to renting. You spend $24,000 a year. The rental prices have just gone. I have a hard time breathing.
They're high.
They're high.
Yeah.
What do you tell people who, we have people in this environment who, in multiple offer situations, to be more competitive, have opted to purchase homes via cash. But they want to turn around almost immediately afterwards and do what's called delayed financing. Can you talk a little bit about that?
Yes, it's simply a cash out refinance that's labeled delayed financing because the rules have to do with when they purchase the home, they purchase it with their own cash, not cash from someone else, and not from a HELOC, a home equity line of credit on another property. It has to be their true asset.
Right.
And then as long as they close on the cash out refinance within those first 6 months from the closing date, then they can do that cash out refinance and recoup most of the time up to 80%, sometimes more on the value of that property.
But the most important part of that is that if somebody does a cash refi or delayed financing, they're actually going to wind up paying a little bit more on the interest rate
Yes.
than if they had done the loan prior to the closing.
Yes, for 2 reasons. One reason is cash out refinances, the government agencies, Fannie Mae, Freddie Mac, they have certain fees they add to those loans that we don't see as consumers, but on the back end it impacts the interest rate. So it usually impacts the rate anywhere from 0.5 point, sometimes more up to a point on a refinance versus on a purchase loan, the interest rates are significantly lower.
Mm-hmm.
Closing costs are about the same, roughly.
One of the closing costs, Steph, that I've seen that has gone up quite a bit in the last couple of years are the appraisal fees.
Mm-hmm.
Lender has to order the appraisal. Have you seen some of these numbers?
I've seen the VA appraisal fee going up to $800.
That's almost double what
Right.
what it was.
used to be.
$400.
It was $400 up until probably 5 years ago,
Yeah.
6 years ago, and
That's
then
right.
it went up to the 500 range, and now it went to 800. It's that right there, I think, has a lot to do with the fact that the appraisal fees were low for so long, not necessarily that they've come up so high when you're talking about VA. And the other problem with appraisals and the fees, VA wanted to raise them to support those appraisers. It's very difficult to become a VA approved appraiser. And so they're aging out, and there's not a lot of new appraisers coming in, so they're trying to retain the talent that they have now.
Who sets the fees for the appraisals?
VA does on VA loans. Other than that, appraisers do, which is the market.
So like homes have increased in price, so have the appraisers realized, and they are backed up. I mean, they are so behind. It's hard to play catch up. And we as brokers have to make sure that when we set a due diligence date, we have to take into account the fact that the appraisers are backed up. We can't always have a 20-day or even a 30-day due diligence period. It will not account for the lending portion of it. Tell me, you've been doing this a long time, but the last year and a half has been surreal. Navigating through all the landmines and the things that could go on and the changing expectations. Share with us something, one of your success stories, something that you went home at night and said, you know what, it's a privilege to do what I do, and I made a difference in applicants, in their memory bank, because you put your heart into it. And so it's not about the money. Sometimes it's about serving the client and making sure that you've gotten them from here to there in the most expedient way. And you can brag on yourself.
I like to feel like we do that every time.
Okay.
But in all seriousness, the PACs, I think, for me, it was a very rewarding relationship.
Oh, okay.
Stephanie and I worked together on the PACs once before, and then the PACs went to their bank for a loan, and they were having difficulties, right, Stephanie?
They were. They had a really good experience using that bank when they bought a restaurant business. But then this is a residential purchase, and they tried to go through the same bank, and it wasn't getting them where they wanted to be. And they had a great experience with you before. They had to leave WF to come to you back right during COVID when they bought their first home, and you saved the day. So yeah, they used you again.
What deterred the PACs from their original experience? Was it the bureaucratic red tape?
The lender at first was, would communicate, and then
too much regulation.
It changed.
Yeah.
I don't remember the full conversation, but I said, Tim called me, and a lot of things were going on with his lender, and the things the lender was asking for, and he provided this to his lender, and then the lender's like, oh, hey, I need this, and he's like, I already gave that to you. I don't hear that from you. When somebody gives you something, you don't lose the documents.
No, we definitely don't.
So I told him, do me a favor and just call Laura, give her the loan estimate that you have, and have her run the numbers. And, if at that point you want to change, we still have time. And if not, then that's okay too. And of course, he's like, definitely 100% we're going with Laura after talking to Laura and looking at the numbers.
They were. And his complaint to me about the other lender was that he didn't feel heard, and they weren't listening to him and what he needed. And I was able to put him in a different structured loan that actually helps him more in the long term to help himself and his family in the future.
Okay. Time is short. I need to pivot. Let's talk very briefly about interest rate locks and how that dynamic has changed, and what do you tell your buyers about the locks that they get, and what happens if they can't meet them?
Well, if they can't meet the lock's expiration date, then they do have to pay to extend that rate.
Right.
That money is being paid for, which is why the customer has to pay for extensions, because it's further paying for the money. And no one's profiting from that. No one gains from that. Nobody wants a customer to have to pay that money. It just is what it is. But normally what happens is a lender should look at the closing date on the contract. They should evaluate the situation from a lending standpoint on the time frame to make sure that it's realistic as it pertains to a rate lock, and then advise the client properly on should we do a 30-day, 45-day, etc. lock. And typically loans do close on time, and that's normal. But new construction,
Let's talk about that.
that's a much different animal. So we need to know as a lender from that client, what is the estimated closing date from a realistic standpoint, understanding that we really don't know, especially with the shortage of materials or the delay in materials. That's a common problem. So it just is very important to have those conversations up front with the customer, that it is their burden to bear if the builder is late.
Yeah.
And it is what it is.
Some lenders who work with new construction builders, volume builders, will say, oh, we can give you way more than a 60-day rate. We can go to 120. And my question is, yeah, but at what cost to you to pay for that interest rate extension? So people have to beware. It's not it's not the same as a 60-day.
No. Each
Okay.
15-day period comes with anywhere between a quarter and a half a point in price, not in rate.
Okay.
So what price means is whether or not there's discount points.
Okay. We have to cut it short. We're going over. Stephanie, if people want to reach you, where can they get you?
910-885-2421 or foreproperties.com.
Okay. Laura, your website, LKurtz at homefactor.com.
Yes.
And you're not based physically in Moore County all the time. You're here every other week, but you're based in North Carolina.
Yes.
And they can reach you at 910-850-7194.
That's right.
Okay. We have 5.5 to 6 months more to go this year. Let's keep over-communicating with our clients and being transparent, and we'll do the very best we can under changing circumstances. It was a pleasure to have you.
Yeah. Pleasure to be here. Thank you.
Always.
All right.
Steph,
Thanks, Laura.
pleasure. This is All Things Moore County. Have a great week.